Right. Good morning. I think we can start now. Uh, Hope you can audible me. So, good morning, everyone. So, I have shared my screen. Is there any problem? You may let me write. I think you have the screen that's on project evaluation.
Yes, madam, we can see the screen.
Right. Okay. Thanks. Right. So we can start now. It's 8:37. So let's see what we were discussing actually. We were on the capital budgeting. Today we have to discuss a bit about the capital structure also because today is your last lecture. So I want to cover to a certain extent that part also. So let's go to the things we stopped last week. You can remember we are on the capital budgeting. Uh, as we discuss non-discounted cash flow method, we did the payback period. In addition, we can use this counting rate of return, ARR, also as a non-discounted project evaluation technique. This is based on the financial statements data or the accounting data. The problem is when we are using accounting data, you know that that's based on the profit mainly. So when we say the profit, you know that profit is not a cash flow. Profit includes some cash, non-cash items like depreciation. So therefore, that generic problems with the profit is affecting to our decisions also when we take this accounting rate of return like techniques to evaluate the project. Anyway, as a technique, you should know what is that. So let's see what is accounting rate of return and how it calculate and how to interpret like this. So I think we did this thing. Right. When it's come to the accounting rate of return, so that is accounting means based on the accounting profit. It's you can calculate uh, average profit after tax profit divide by average investment. So you can calculate accounting rate of return using this formula. You can see in the screen average profit. So we are using here profit after tax net profit, not the cash flow, divide by average investment. So average rate of return found by dividing average after tax operating profit by the average investment. So normally, slowly based on this accounting rate of return, only you cannot take any decisions. You can use as a supplement with the other techniques like NPV, IRR, payback period. So independently, if you are taking decision based on only the accounting rate of return, that might not be a good decision. But anyway, you can see we can calculate like this. Uh, Average investment, normally you can calculate initial investment plus end of the project investment divide by 2. This IN, right? I substitute N. So that is end of the period investment. I0 is the initial investment. Divide by 2 is the average. So normally in a project, not only the initial period investment, there might have some more investments during the project lifetime. So therefore, you can calculate average like this. If you have given, say, like this, only the initial year investment, and also if it is say that this investment is depreciating throughout the life of the project like this, so then average investment you can take as the half of the investment. That means initial investment divided by the 2. So acceptance rule, you can see if accounting rate of return is greater than the minimum one, we can accept. If accounting rate of return greater less than the minimum, you can reject. So what is this minimum? Actually, it is a subjective number. It depends on company to company. There is no any theoretical minimum rate that's vary. as per the requirement of the financial manager of that particular company, of that particular industry. So like it's not a fixed theoretical value. But anyway, some are using here cost of capital. Cost of capital of the company or cost of capital of the project as the benchmark, as the minimum. So then you can compare accounting rate of return with the company or the project cost of capital. So if ARR is greater than the project cost of capital, you may accept. If ARR less than the cost of capital, you can reject. So this is the decision rule. So let's see how to calculate this one quickly with example. So look at this example. You are given a project 5 years. Year-end investments are given like this. So there are investment during the life of the project. Initially 200, 180, so 160 at year 500,000, so likewise. And this is EBIT. EBIT mean earning before interest and tax. So that is we call operating profit. So EBITs are given for each year. So let's take the tax rate as 30%. So then you can calculate after tax profit, after tax EBIT for each year. So they after calculating this, you can calculate accounting rate of return. ARR or the accounting rate of return is equal average after tax net operating profit divided by average investment. So here average investment you can calculate. Initial year investment 200,000 plus, end of the period investment 100,000 divide by 2, because this is investments are there for each year in the period project lifetime. So therefore you can take the average like this. In some textbooks they are taking average as total divided by 5. So these are some gray areas in the accounting rate of return calculation. Some different textbooks are explaining this one using the different way. But anyway, in this case, I prefer if you are taking initial period investment plus terminal year or the end of the period project investment divide by 2 likewise. So let's see the calculation. So you have to work out after tax profit first like this. So you can see the answer here. You can check with your calculators and the calculating it. So this is after tax operating profit. Tax rate is given 28%. So then you can calculate this is before tax profit 40,000. So 40,000 you have to adjust it for the tax. So then you will get 40,000 into 1 minus tax rate. So then this is 28,000 is the after tax profit. For each year, during the life of the project, you have to calculate after tax profit. So these are the numbers you can check with you. So these are the after tax profit. So these are the investment. So now you can calculate average profit. So average profit means 28 plus 30.8 plus 33.6 plus 36.4 plus 39.2 divided by 5. 5 is the life of the project. So this is the average profit. So average investment, as I mentioned earlier, 200 plus 100 divided by 2, 150. So then you will get accounting rate of return is 22.2, 22.4%. So this is the answer. Now this 22.4, in order to assess the project, you can check with in practice that is doing, you can compare with the project cost of capital or company cost of capital. If project risk and the company risk are same, then company cost of capital you can take as the project cost of capital. So some practically, some in practice, this cost of capital is using to compare with the accounting rate of return, right? I think this is not difficult calculations. You can calculate and you can check this answer later. If you have any questions, you may disturb me and ask, right? So because this is online, I may go it fast, not like in the physical class. So, but anyway, anytime you can disturb and you can ask anything. Right. So if you look at the characteristics of the accounting rate of return, you can identify some advantages and limitations like this. This is based on the accounting data. So getting data is easy because normally from the income statement, you can take the accounting data like profit. This is very simple again, like payback period. Limitations, you can see main limitation, it ignore the time value of money. We are not doing any adjustment for the time value of money because we are taking here profit, right? Profit, when you calculate in profit, you know that nothing we are doing for the time differences. So therefore, we did not consider time value of money. It does not consider the cash flow because average profit, not average cash flow. So that does not consider the cash flow, not definite method to determine cutoff. So this is again a problem. There is no any method, any theory to determine what is the appropriate ARR. What should be the appropriate level? So to determine that one, there is no any theoretical backing. There is no any theory to determine that. So this is also one limitation. As a technique, you cannot take decision purely based on this because of these limitations. So these are some limitations and the advantages. You can read the uploaded chapter also for get more understanding about this ARR also. So this is what ARR, how to calculate and how to interpret that. So this is a question in the tutorial. I think you can check it later and try to do it, right? So I'm moving to the net present value. This is one of the very important, highly using, practically, mostly we are using techniques for the project evaluation is the NPV, or we call net present value. Right? So net present value, what is simply net present value is present value of the cash inflow minus present value of the cash outflow. For a project, you have to identify net cash inflow or outflow for each year. I think you may remember we discussed cash flow estimation at the previous week. You can remember for a project, you should identify what is the initial year cash flow, what are the after-tax net operating cash flow during the life of the project, and terminal year cash flow. So before applying these techniques, you should estimate cash flows for the project. After you identifying the cash flows, you can calculate like NPV, payback period, all the things. Right. So what is the NPV? NPV is the present value of the cash inflow. PVC, I mean present value of the cash inflow minus present value of the cash outflow. So when we say the present value, you know that. You know, when we say present value, what it implies. Present value mean time adjusted cash inflow, time adjusted cash outflow. So the difference between the present value of the cash inflow and the present value of the cash outflow, we call as the net present value, NPV. So when you calculate the NPV, the answer can be positive, negative, or zero. When the present value of the cash inflow greater than the present value of the cash outflow, your NPV will be positive. When the present value of the cash outflow is greater than the present value of the cash inflow, your NPV will be negative. If these two are equal, your NPV will be zero we call it as a marginal profit because there is no value creation or value destroyed. We call it as a marginal profit, project in break even. Right. So if NPV is positive, acceptance rule or the decision rule is very clear. It's very theoretically strong. If project NPV is positive, you can accept the project because suppose that you have calculated NPV, say it is positive 100 and say 100. Project NPV is positive 100. So what it implies? What it implies? It implies that if you accept this project and if you continue this project successfully until its life over, your wealth or your value will increase by 100 rupees. Right? So that is the meaning. If positive NPV, if it is 100, it implies that by accepting and by continuing this project, your value you can increase ultimately by 100 rupees. So therefore, if project NPV is positive, you can accept the project. If it is negative, say it is negative 100. So it implies that if you accept this project, your wealth will destroy or your wealth will decrease by 100 rupees. So you may not accept such a project because by accepting such a project, your value not maximizing. Your value is not creating. I think you can remember our objective of financial management, first lecture. Maximizing shareholders' wealth, maximizing market price of the share, maximizing value of the business. So you can see the objective of the financial management is aligned with this evaluation technique. Value can create by long-term investment. I think you may remember in the first lecture that diagram, role of financial manager. In order to create value, financial manager should invest, raise capital in a value creating project. By investment, when the value is created, shareholders' wealth will be maximized. Market price of the share will be increased. Value of the company will enhance. So likewise, you can see when the project NPV is positive, it's aligned with the objective of financial management even, so you can accept the project. If it is negative, you may not accept. When the project NPV is 0, it implies that by accepting this project, there is no value creation, there is no value destroyed, so you can decide. Either you can accept or you can reject because the project is marginal, no effect. So that depends on the finance manager's decision. So based on the real options or the happenings in the economy, you can decide whether the project is accepted or not. Because you know that when we say the long-term investment project, that is going for the long period. Based on the expected cash flow, we forecasted, we have calculated here NPV. However, in reality, these forecasted numbers can be different. So it can be go to a good side as well as it can be sometimes go to the worst or the bad side. So therefore, when you are estimating the cash flows for a project, we have to consider all possible happenings in the economy, all possibilities during the life of this project. Inflation, interest rate changes, foreign exchange market changes, government influences, environmental factors. So likewise, all the factors, all the risk factors we have to consider. So by considering all these factors, the project discount factor, project cost of capital, we determine. So based on this project cost of capital, By discounting the project cash flow, you are calculating NPV. Right? So I think now you have some idea, some what you call some picture about this project evaluation. So here we are taking very simple example. But you know that this cash flow estimation is a very difficult part. අපි අද ફોકસ කරන අවුරුදු 5කින් මෙච්චරක cash flow එක by considering as much as possible all happenings. අපිට පුළුවන් විදිහට analyze කරලා අපි පුළුවන් තරම් සියලුම techniques පාවිච්චි කරලා සියලුම real options identify කරලා අපි focus කරනවා. But anyway, in the reality, that can be go other way around. So this is the risk. This is the risk of the long-term investment. Right. So then if it is zero, that is marginal, either you can accept or reject. So if you look at the characteristics, all are very positive. It consider time value of money. Nothing to explain. Now you know that what is time value of money. So when you calculate net present value, you are using time adjusted cash flow. You are using time adjusted cash flow. So we consider time value of money. Cash flows are considered. Yes. NPV we calculate based on the net cash inflow of the project. Assume the cash flows over the project are reinvested. So this is very important character or the assumption. So when we calculate this net present value, there is an implied assumption. What is the assumption? We assume that during the life of the project, cash generated by this project are reinvested at least at the cost of capital of the project. This assumption is very important. Without this implied assumption, the calculated NPV is not correct. Right? When you calculate in this net present value NPV, there is an implied assumption. What is the implied assumption? Cash flows you are generating through the project. If it is a 10 years project, there is a cash inflow year 1, year 2, year 3, year 4, year 5, so likewise. So the cash you are generating in the early period of the project are reinvesting in the project, or it means that are reinvesting at least at the cost of capital of the project. Project cost of capital. අඩුම ගානේ මේ rate එකට අපි ඒව reinvest කරනවා. So that is very strong assumption. So that actually NPV is based on this assumption. So you are calculating NPV based on this assumption. Cash flows are reinvesting. දැන් අපි පළවෙනි අවුරුද්දේ හම්බෙච්ච cash flow එක ලාට්චුවේ දාලා තියන් ඉන්නේ නැහැ. We are reinvesting it. අපි ඒක බැංකුවක දානවා වෙන්න පුළුවන්. මොකක් හරි project එකේ කාලය තුල we are reinvesting at least cost of capital of the project. ඒතර ඒ assumption එකත් එක්ක තමයි මේ NPV calculate වෙලා එන්නේ. So this is absolute measure of the wealth. Yes. This NPV is very perfectly aligned with the objective of financial management. It's an absolute measure of the wealth. If NPV is positive, it is the increase of the owner's wealth. If NPV is negative, it is the decrease of the owner's wealth. So the NPV is an absolute measure of the wealth. I think that is clear. So let's look at this example. A project cost is 200,000. Yeah, you are given a project 200,000. Net cash inflows are 50,000 year 1, 100,000 in year 2, 150,000 in year 3. So discount rate, appropriate discount rate, or the project cost of capital, or the project required rate of return. I think we did the cost of capital. You know conceptually what is cost of capital now. So you are given the discount rate, or that is the appropriate cost of capital, or the required rate of return is 12%. So what is the NPV? Calculate it. I'll let you few seconds. What is the NPV? So you can calculate NPV is equal present value of the cash inflow minus present value of the cash outflow. So this is a 3-year project. Net cash inflows are given, right? Look at this net cash inflows. So after considering cash inflows, outflows, all net cash inflow, net effect is given. Year 1, 50,000, 10, 100,000, 150,000. So you have to calculate present value of the cash inflow. So you know that 50,000 is the expected cash flow in year 1. So in order to calculate its present value, you have to discount this by 1 year. So the rate is 12% discounted by 1 year plus year 2 you expect 100,000. 100,000 you may discount by 1.12 into the power 2 plus 150 discounted for 3 years. So these are the present value of the cash inflow. These are the present value of the cash inflow minus present value of the cash outflow. The cost of the project is 200,000. So initially investment or the cost is 200,000 at 0. So its present value is equal to 200,000. Same. No need to discount it because it is at 0. In the timeline, it is at 0. So then deduct 200,000. So you will get the net present value. Is it positive or negative? You can tell me the answer or you can put it into a chat message, chat box. What is the NPV? What is the NPV?
It is plus value, madam.
Is a plus one value. So the answer is you will get, you can check the answer. 31,129. Is it correct?
Yeah.
Right. So your NPV is positive, is a positive one. So it means that by accepting this project, your value, your wealth can increase by 31,129 approximately. So you can accept the project because NPV is positive and it is greater than 0. So you can see the criterion or the evaluation acceptance rules are very clear, theoretically very strong, right? Not like the payback accounting rate of return. So that theoretically very strong. So if it is positive, you can accept. Right. Right. So this is about the NPV in very simple way. Then the next one is the IRR. Internal rate of return, IRR. So actually this IRR, we have calculated in related to the bonds. If you recall the things we discussed under the bond valuation, IRR we have calculated in the bond valuation as the YTM. You remember the YTM, yield to maturity? YTM, we calculated it in the bond valuation. What was the YTM? You can look back and you can see what is YTM. YTM was that like if you invested today in a particular bond at today's current market price, and if you keep this bond until its maturity, And if all coupon payments and the redemption value, if received as per schedule, your realized rate of return through this investment is the YTF. At that time, we discussed that was the YTF. So YTF means your investment internal rate of return. It is the return internally generated through this investment without affecting to external factors. This is implicit. This is intrinsic to the project or to the investment, right? So internal rate of return mean that is the internally generated rate of return from the project. So you can see some explanations are there. Internal rate of return, or we call IRR, is the discount rate which equates the present value of the investment cash inflows to the outflows is we call IRR. So what is the IRR technically? If you recall the YTM also, same thing. So that is the discount factor, which present value of the cash inflows of the project are equal to the cost of the project. In the YTM calculation, you can remember present value of the coupon, present value of the redemption price. It is the discount rate at which present value of the coupon, present value of the redemption price is equal to the market price. That discount rate. අපි ප්‍රොජෙක්ට් එකේ අපි බලාපොරොත්තු වෙන මුදල් ප්‍රවාහවල වර්තමානයේ අද ඉන්වෙස්ට් කරන කොස්ට් එකට සමාන වෙන අවස්ථාවේ තියෙන වට්ටම් සාධකය. So that is the IRR, or internally generated rate of return through a project. Right? So you can see technically IRR is the discount rate which equates the present value of the investment or the project cash inflows and outflows. Right? So at IRR, remember at IRR, NPV is 0. Always at IRR, net present value is 0. So then you can tell in another way also, IRR is the discount rate when the NPV of the project is 0. When the project is going to marginal. If you look at the second bullet, IRR is financial metric used to estimate the profitability of the potential investment. So we are evaluating using the IRR, the project internally cash generated ability, because this IRR is coming through the project. Intrinsically through the project. It's not affecting to any external variable like cost of capital or whatever. Right? So therefore, IRR is a financial metrics used to estimate the profitability of potential investment. And IRR is internal or intrinsic to the project. Api project එක තුලින් internally generated return එක තමයි identify කරගන්න. So then that IRR is internal. It is intrinsic to the project. It only depends on the cash flows of the project. So IRR will depends on the cash flows of the project. So I think you have some idea about the IRR. So it is the discount rate that makes the net present value of all cash flows equal to 0. Technically, at IRR, NPV is 0. So therefore, IRR is the discount rate that makes the net present value of all cash flows is equal to 0. So this is IRR. So this IRR is very important. By identifying the internally generated rate of return of a project, you can see its overall profitability, effectiveness of the project, and also to decide whether you accept or not this particular project. So this is the evaluation criteria. IRR, you can compare with the cost of capital of the project. If IRR is greater than the cost of capital, project is, you can accept. If IRR less than the cost of capital, you may reject the project. If IRR is equal to the cost of capital, either you can accept or reject. Remember, when IRR is greater than the cost of capital, NPV, when the IRR is greater than the project cost of capital, what would the NPV? NPV always greater than 0. NPV always is positive. When IRR is greater than the cost of capital, in a conventional type project, conventional type projects mean project like this. We discuss in this lesson only the conventional type project. In conventional type projects, at the initial year, there is an investment. After the investment, there is a cash inflow. So you can see inflows, positive cash flows. So you can see here signs, minus plus signs are changing only one time. Initially investment, after that inflows. So these type of projects we call as the conventional type project, traditional project. But remember, in the practice, always projects are not like this, not conventional. Why? The positive, negative signs can be changed in the different time. So that means initially there is a outflow, investment. So then there is a inflows. During the project, there can be another investment. Again, inflows. There can be another investment. So likewise, reality in the practice, projects are like this. So we call them as an unconventional project. But in this course, we consider only the conventional type project. So in a conventional type project, when the IRR is greater than the cost of capital, NPV always positive. NPV always greater than 0. When IRR is less than the cost of capital, NPV is negative, less than the 0. When IRR is equal to the cost of capital, NPV is equal to 0. So this relationship also you can observe when you compare the IRR and cost of capital like this. When the IRR is greater than the cost of capital, you can accept the project. ඒ කියන්නේ project එක තුලින් generate කරන rate of return එක project එකේ cost එකට වඩා වැඩි. Cost of capital කියලා කියන්නේ project එකේ minimum required rate of return එකනේ. අපි project එක තුලින් බලාපොරොත්තු වෙන අඩුම අවම ප්‍රතිලාභ අනුපාතය. So that is minimum required rate of return. So if the IRR is greater than the cost of capital, you can accept project. So then the project NPV also positive. When the IRR is less than the cost of capital, you may reject the project. So that NPV, if you calculate at that time, it's also negative. So IRR and cost of capital if equal, it implies that NPV is 0. This is applicable for a conventional type project. So I explained you, these are the conventional like projects. Right. So here cost of capital mean your opportunity cost of capital or the required rate of return. So now let's see how to calculate the IRR. So before going to that, look at these characteristics. Characteristics of the IRR. Consider time value of money. Yes, because IRR we calculate time adjusted cash flows. IRR we calculate based on the time adjusted, not the non-discounted. Time adjusted cash flows are using. This one is very important. When you calculate the net present value, your reinvestment assumption was, when you calculate the net present value, your reinvestment assumption was cash flows are reinvesting at cost of capital. The project cash flows generated through the project are reinvesting at cost of capital. When you calculate the IRR, internal rate of return, your reinvestment assumption is like this. IRR assume cash flows are reinvested at IRR. Right? When you calculate in the IRR, reinvestment assumption is that we assume that cash flows are reinvested at internal rate of return, not at the cost of capital. So cost of capital mean it is the going market interest rate at present. Cost of capital represent. Cost of capital is an indicator for the current going market interest rate or current investors required rate of return. When you are calculating the net present value, your reinvestment assumption was at the cost of capital. In the IRR calculation, your reinvestment assumption is IRR. Right? So we assume that cash flows are reinvesting at the IRR. This is a bit unrealistic. Why? This IRR is not the current, that not reflect the current market interest rate. So we are assuming that when you are calculating the IRR, we assume that cash flows are reinvested at IRR. So sometimes this IRR can be a overestimated value. You cannot see this IRR in the practically at the marketplace. So therefore, sometimes it can be an overestimation. Because of that, I think I explaining in the next after this discussion of this one. Because of this assumption, there is a conflict between IRR and NPV values. So let's discuss that with the modified internal rate of return calculations also. So there can be a disagreement, conflicts in the project selection by NPV and IRR because of this unrealistic reinvestment assumption. I think you realize this point, right? If you need further explanations, please let me. Right. So the third one, unusual cash pattern can result multiple rates of return. So here we discuss only the conventional type project, but projects are not conventional always. So when the multiple cash outflows, inflows. So likewise for unconventional type of projects, multiple IRR issue can be seen. Multiple IRR issue. It means you are getting two IRRs. ප්‍රොජෙක්ට් එකේ ලයිෆ් එක තුල IRRs දෙකක් තියෙනවා. NPV එක බිඳු වෙන අවස්ථා දෙකක් තියෙනවා. So we call it as a multiple IRR issue. So this multiple IRR issue can be seen when the unusual cash flow pattern is there. So that means when the project is not conventional. In unconventional type projects, this multiple IRR problem you can see. So how to resolve or how to face this problem? You can calculate modified internal rate of return by assuming reinvestment assumption changing to the cost of capital. So I am explaining that point later. So that is a problem. Multiple IRR issue. Right. So look at the next bullet. If NPV and IRR criteria is disagree, suppose in your exam paper, I have given a question. I'm asking you which project you are going to select. So based on the NPV, say the two projects are there, A and B. So NPV say that project A is the good. But when you calculate the IRR, you can see that project B is the one. So now there is a disagreement. So in such a situation, if such disagreements are occurred in your calculation, so you can go with the NPV. So it's the preferred one. So you can take the decision based on the net present value. You may take the decision based on the net present value. So you can see for the conventional type project, If NPV is greater than 0, IRR is greater than the cost of capital. If NPV is less than 0, IRR is less than the cost of capital. For conventional type project, this relationship you can observe. Right? When the NPV is positive, IRR is greater than the cost of capital. When the NPV is negative, IRR is less than the cost of capital. So this you can observe for the conventional type project. So let's calculate IRR. Assume the cost of the project is 60,000. It is expected to generate cash inflows. Net cash inflows are given 20,000, 30,000, 40,000 through its 3-year life period. Calculate IRR. So you know how to calculate IRR. So technically, IRR is the rate at NPV is 0. IRR එක කියලා කියන්නේ තාක්ෂණික වශයෙන් NPV එක බිඳ වෙන අවස්ථාවේ discount rate එක. Is the discount rate at NPV is 0. So I think you may remember the YTM calculation. There you can remember YTM we calculated by identifying appropriate range and preparing loan amortization, linear interpolation table. And based on this linear interpolation table, you can see approximately we calculated IRR. But anyway, if you are using Excel, there is a function IRR. Quickly, you can go to the IRR function and you can calculate. But here for the exam, again, you have to apply trial and error method or the linear interpolation method. That is the way. So, right, let's start with the calculation. So, not like the YTM. In the YTM calculation, there was a chance to guess the starting discount rate. I think you may remember if the bond is selling at discount, coupon rate is less than the YTM. When the bond is selling at premium, coupon rate is greater than the YTM. So likewise, sort of relationship are there for the bond to determine the starting rate. But for here, no any hint. There is no any hint or any theory to determine that. Simply by chance, fully by your choice, you have to start with one discount factor. So let's start with 10%. So at 10%, calculate, taking the cost of capital as the 10%, calculate 10% value. Calculate the project NPV at 10%, see whether it is positive or negative. Here IRR mean it is the discount rate at when NPV is 0. So let's start with the 10%. See at 10% what is the NPV? So NPV as 10% is equal 20,000 discounted by 10%. This is year 1 plus 30,000 discounted by 2 years back, 40,000 discounted for 3 years. So these are the present value of cash inflows minus cost of the project. Present value of the cash outflow is 60,000. So tell me what is the NPV at 10%?
$13,027.
13,000
27.8. 80.
13,020. 13,027, eh? 13,027,
Yeah.
right? 13,027. Is it positive, no?
Yes, positive.
Right. So then what you have to do, the NPV is positive. So you have to identify a range with the positive NPV and negative NPV. Range should be narrow as much as possible because we are going to do a forecasting. So now the at 10%, the NPV is positive, some big value. So let's recalculate NPV. So now you have to decrease this NPV. So we have to identify a negative one also. So in order to decrease the NPV, you have to increase the discount factor. So let's start with this is positive. So let's try with again at say 18%. Tell me what is the NPV at 18%. So what you have to do? Now you are changing discount factor. So you are changing here. Now the discount factor is 18%. So then 20,000 discounted by 1.18 into the power 1 plus 30,000 discounted for 1.18 to the power 2, 40,000, 1.18 into the power 3. So this is the present value of cash inflow minus 60,000 is the cost. So now what is the NPV?
$2,839.92.
It's still positive, ne?
Yeah.
2,000.
839.
Approximately.
Yeah.
Right. So now positive NPV, but the positive number is very low. So now you can, if you further increase, now you have to identify a negative NPV also now. So now still positive. So therefore now you can increase the discount factor further. So now it is 18%. So let's the hard time. Let's go with the 20%. Quickly change this 18% and see what is the NPV. At 20% also, is it positive still?
Negative.
Negative. What is the number?
2,824.
Negative 2,000.
824.
124. Right. So now negative NPV and positive NPVs, they are in between this 18% and 20%. Now based on this range, you can approximately identify internal rate of return. So now we are taking these two numbers. At 18%, NPV is positive 2,839. So we are seeking in this calculation rate here when the NPV is 0. At 20%, if you take the 20%, NPV is minus 2,824. So based on this table, let's calculate IRR approximation. IRR is equal greater than the 18% plus. So you remember the YTM calculation, difference between the large value and the small value. So here large is 28,339. Lowest is minus 28,024. So the difference between this largest and the lowest one means how much? 2,839 minus 2,824. So then minus will become positive. So how much the difference? So 2,839 plus. Is 5,663. For this difference, the rate has here differentiated by 2%. So then for this difference, here difference is positive, no? 2,839. For 5,663 differences, the rate has differentiated by only 2%. So then for this gap, for this difference, this 18% should increase by how much? So now solve this. Let's see the number. So here you will get by calculation 0.0100 plus 0.18. So approximately is it 19%?
Yes.
So this is the IRR. This is the IRR. Same thing you can, this is our approximation. So same thing you can work out from the Excel also. Anyway, Excel number, it was 21%. 20.61 in the Excel. Even in the Excel, you can see there is a function called IRR. So you can apply this IRR function. So you have to give the values here. 60,000, 20, 30, 40. So then it will give you the approximately IRR around 20.61. Here in our calculation, it was 19%. This is approximation number. Let's see the 20.6167 is the answer. Are we doing any mistakes here? 19%. 19%, what is the 19 point? What is the decimals? 19 point?
I
No?
think 20% NPV is not minus amount. It's plus amount 648, I think.
Yes, NPV is not positive one.
At 20%, at 20% also NPV is not positive.
Yes,
Yes, madam.
it's positive. It's positive.
It is positive. So then you can't take this. If NPV is positive at 20%, range is out of the IRR. So then you cannot apply this too. So then again you have to recalculate NPV using another number. So now you can increase it is for the say another 2%. So now you can look at now it is at the 20% also NPV is positive. So let's look at 21% or say 22. So how much the NPV at 22? So let's change the rate and calculate. ඒක තමයි NPV එක ඇවිල්ලා IRR එක ඇවිල්ලා නැත්තේ. So now you have to recalculate net present value using here I'm taking 22%. So at 22%, what is the NPV? 20,000 into 1.12 into the power minus 1. Is it negative 1,422? Yes, 1,422, no?
Yes, ma'am.
Right. So now you can calculate. Now at the 22%, NPV is negative. 1,422. So now our linear interpolation table is at 20%, NPV is positive 2,824. So we are seeking the rate when the NPV is 0. At 22%, NPV is minus 1,422. ඒතර බලන්න range එක වැරදුනොත් you are not getting the correct IRR. So now IRR approximately is equal, it is greater than 20
Madam,
plus.
again, for NPV,
The 20%. At the 20%, it is 648 plus value.
මේක වැරදිද?
Yeah.
6,600.
648.
ඔයාලා කියපු එක තමයි ගත්තේ 648. So this should be 648. Right. So now it is correct. So the difference between the largest and the smallest value means 648 plus 1,422. So that is 2,070. For this difference, rate has differentiated only by the 2% here. So then for 648. So now check the answer. It is 20.6 is the IR. Now it is correct. 20.6. So identifying this first cost, discount factor is totally by your random choice. So this 18% or 10%, whatever, it's coming from your guessing. Is a random number, random value. Right. Now suppose that cost of capital of this project or the project required rate of return is say 15%. For this project, required rate of return or the project cost of capital is set 15%. What is the decision? Are you accepting project? If the project cost of capital is 15%, what is the decision?
Accept.
We can accept because the IRR project internally generated rate of return is 20.67. So this is the rate of return at NPV 0 when the project is marginal. So then you can see it is greater than the cost of capital, you can accept. Suppose the project cost of capital is 22%. Now there is a problem. You cannot accept because cost of capital of the project or the project required rate of return is 22%, but the IRR is 20. So then you cannot accept the project, you may reject. So likewise, by comparing the IRR with the cost of capital, you can take the decision. So here also the decision criteria is conceptually very strong. It is very clear. IRR you can compare with the cost of capital of the project. Right. Now I think it is IRR, how to calculate. Now let's go to the some more discussion on this IRR. Now if you look at this diagram, this is for the independent project. So I think you remember what is the independent project. Independent mean acceptance or rejection of the one, not influencing to other. So the projects are independent. So we are evaluating this project for the different purposes. So these are projects we call independent. So for the independent projects, there is no conflict between IRR and NPV. So if you look at this, this is a NPV profile, right? This blue line we call as NPV profile. So what is the meaning of NPV profile? So you can calculate NPV values for the project. Here, change in rate. So here you can see in the x-axis that is rate or required rate of return, cost of capital. So you can calculate NPV. In the y-axis you can see this is NPV, net present value. So you can calculate NPV for the different rates of return. And if you draw a line like this based on that numbers, so this is we call NPV profile. Right? In this NPV profile, you can see for this particular project, this is the IRR. This point is the IRR. Because here you can see NPV is 0. So this is the IRR. Right? So when the IRR is greater than the cost of capital, right? So these are the now different cost of capitals, right? So this is point where the IRR. So when the IRR is greater than the cost of capital, so let's say for the understanding, suppose here IRR is say here the number is say 20%. This is the 20%. Suppose here there is a number 15%. So when the IRR is greater than the cost of capital, no conflict because you can see NPV is also positive. So you can see these are the positive NPVs. Right? When the IRR is greater than the cost of capital, මෙතන තමයි IRR එක තියෙන්නේ. IRR එක 100 cost of capital එකට වඩා වැඩි වෙනකොට conflict එකක් නැහැ. There is no disagreement, conflict between the IRR and NPV because both IRR and NPV say these projects, the project can accept. This is independent project. And also when the IRR is greater than the cost of capital is greater than the IRR. If you take a number here, say here, this is 30%. Cost of capital is 30%, but the IRR is 20%. When the cost of capital is greater than the IRR, again, no conflict, because if you look at this rate, here this level, NPV is negative. NPV එක මෙහෙට තියෙන. So the NPV, the line එක මෙහෙමනේ යන්නේ. So then NPV is negative. NPV is somewhere here. So then both says project should reject. Right? So no conflict. When the IRR is greater than the cost of capital, no conflict between the NPV and IRR criteria. And also when the cost of capital is greater than the cost of IRR, no conflict between the NPV and IRR. So there is no issue, no conflict for independent type project. But if you look at this, we are coming to this diagram for the dependent project. Sorry, not the mutual exclusive project. These are independent. You can define the independent one. So when it is a mutual exclusive project, so likewise, say this is two projects, L and S. 3 years project, initial investment for both 100,000, net cash inflows like this. Project recurrent rate of return at 10%. So if you draw the NPV profiles, so this is, you can see NPV profile for the project L. So at different cost of capital rates, change in the cost of capital, you can see 5%, 10%, 15%, 20%. So likewise, change in the cost of capital, you are calculating NPV. So that is we call NPV profile. Here for the project S also, you have calculated NPV for the different cost of capital levels. So this is its NPV profile. So you can see NPV profile is a graphical illustration of the project NPV graph as function of various discount rates, cost of capital. So normally at zero cost of capital, here in the first one, you can see it is 0. NPV simply is the project's undiscounted cash flows. You can see the third bullet at 0 cost of capital, NPV is equal to total of project's undiscounted cash flow. Now, if you look at this the project L, undiscounted cash flow total mean 80, 60, 140 plus 10, 150. So you can see 50 minus cost. NPV, no cost, you have to deduct, no. So then you will get here NPV 50,000. For this one also, 70, 50 plus 120 plus 20 means 140. From 140, you have to deduct the cost 100. So then you can see NPV is 40,000. So at 0 cost of capital, NPV is simply equal to the undiscounted cash flow based on the undiscounted cash flow values, right? So that is for your knowledge. So now these are the graphical table for the NPV profile. So now if you draw this one in a graphs like this, look at this one. Red line is the project L. Yellow one is for the project S. Here we call this point as the crossover point or the crossover rate. You can see at this cost of capital level, both projects are having same NPV. So that point we call as the crossover point or crossover rate, right? So crossover rate is the cost of capital at which the net present value for two projects are equal. Or it is the point at which the NPV profile is one project crosses over or intersects the NPV profile of the other project. So now in this presentation, it's not correctly showing you, but anyway, if you draw in Excel, you will get crossover rate here 8.7%. So at 8.7 cost of capital level, right? At 8.7 discount factor, at 8.7 cost of capital level, both projects have same NPV. So you can see here This is the NPV. They are getting same NPV, net present value. So if you look at this one also, this is the point where the NPV is 0. Here, this is the IRR for the project L, 18.1. For the project S, this is the IRR, 23.6. මොකද IRR කියන්නේ NPV එක බිඳු වෙන අවස්ථාවේ discount factor එක. ඒතකොට if you look at here, මෙතනදී NPV is 0. So this is the IRR for the project L. This is the IRR for the project S. So what is the problem here? Now, if you look at same diagram, when the cost of capital is less than the crossover rate in this range here, right? So this is the crossover rate, 8.7. So when the cost of capital here, this range, less than the crossover rate, there is a conflict. Why? Now, if you look at this 5% level here, for this 5% level, this is 5%. So this 5% level, you can see at 5%, this is the 5% level NPV. This 5%, this is the NPV project L, and this is the NPV for project S. I think you can take this, right? At the 5% discount rate, this pink color one is the project L, yellow one is the project S. So this is the NPV for the project L. This is the NPV for the project S. So NPV project L, you can see greater than NPV project S. But IRR, yellow one is the IRR for the project S. This pink color one is the project L. So IRR S is greater than the IRR L. You can see there is a conflict. There is a conflict. According to the NPV at 5% cost of capital level, අපි හිතමු market interest rate at 5%. At 5% cost of capital level, according to the NPV of project L is greater than the NPV of project S. But IRR say, IRR for the project S is greater than the IRR project L. So there is a conflict, disagreement. When the cost of capital is less than the crossover rate. When the cost of capital is greater than the crossover rate, suppose the cost of capital is there, say this is 15%, here, 15%, greater than the crossover rate, 8.7 the crossover rate. So now here, this is the NPV. This is the NPV project S. This is the NPV for the project L. So NPV project S greater than the NPV project L. IRR also, IRR project S greater than the IRR project L. So no conflict, no problem. For the mutually exclusive project, from the mutual exclusive project, you have to select only one. You have to select only one. When the cost of capital level, if decreased to the crossover rate, there is a conflict. If cost of capital level, if it is increased to the crossover rate, no problem. So now when you are taking the decisions, you have a problem how to solve this. Now further, if you look at this one, you can solve this by calculating this modified internal rate of return. So before going to the modified internal rate of return is a solution for the multiple IRR problem also. Now, if you look at this project, project, you can see 1.6 at 0, 10 year 1, again outflow 10 year 2. So this is not a conventional type project, because you can see signs are changing more than one time, minus, positive, minus. So this is we call non-conventional project. So if you draw a NPV profile for this project, so you can see here NPV profile at different interest rate, 0, 10%, 25, 110, 400, 500. So different interest rate, if you calculate the NPV, so these are the numbers. So you can see there are at 25% NPV 0, again at 400% NPV 0. So two IRRs. We call multiple IRR problem. So this multiple IRR problem occurred when the projects are not conventional. When the project cash flows are unconventional like this, so this multiple IRR problem is possible. So now if you draw the NPV profile graphically like this, you can see this is one IRR at 25%. There is another IRR of the project at 400%. So now this is also a problem with the IRR. Some projects are having more than one IRR, multiple IRR. So what is the solution for this? Also, you can go with the modified internal rate of return. For this one, this problem, now there is a conflict when the IRR is, when the cost of capital is less than the IRR. Sorry, crossover rate. There is a conflict. The reason for this one, actually the reason for this disagreement is unrealistic reinvestment assumption in the IRR. When you calculate in the net present value, our reinvestment assumption is cost of capital. But when you calculate the IRR, reinvestment assumption is the IRR. So if you look at here, now cost of capital here 5%. So when you calculate the NPV for the project L and project S, you assume that cash flows are reinvested at 5%. But IRR assume that cash flows are reinvested at IRR 18.1, 23.6. So this is very unrealistic. This is not the reality in the market. Actually, this conflict is arising because of this unrealistic assumption in the reinvestment cash flows. You can overcome this problem by calculating modified internal rate of return, or we call MIRR, modified internal rate of return. So what is this modified internal rate of return? Very simple. Is the discount rate that causes present value of the project's terminal value, causes the present value of the project's terminal value to equal to the present value of the cost. So what is that? If I further elaborate, terminal value mean, so you have to value the project to the terminal year. So MIRR, or the modified internal rate of return, mean it is the discount rate where the terminal value of the project is equal to the present value of the project. Right? So let's do with the example. But now here, when you are calculating this MIRR, we assume that cash flows are reinvested at cost of capital. So our assumption is now changing. In the modified internal rate of return, when you calculate the MIRR, or the modified internal rate of return, reinvestment assumption is the cost of capital. So we assume that cash flows are reinvesting at the cost of capital. So that is realistic. Cost of capital means that is ongoing market rate. So then terminal year cash flow found by compounding inflows at the weighted average cost of capital. The terminal year cash flow you have to calculate by compounding. So you are compounding project. You are taking project to the terminal year. So then you have to compound the cash flows at cost of capital to the terminal year. So let's calculate with example. Now look at this one. Two projects. Same one, right? Api metana gatta same two projects. Yes, LS1. So what you have to do, you have to calculate modified internal rate of return for the project L and project S. Right. So let's calculate the modified internal rate of return for the project L first. So MIRR mean project terminal year cash flow. It is the discount rate where the terminal year cash flow is equivalent to the cost of the project. You can go to the definition. What is the MIRR? It is the discount rate which causes present value of the project's terminal value is equal to the cost of the project. So now if you calculate for the project L, so project L is like this, no? So you are investing at 100,000. This is the cost of the project. The project is 3 years. 1, 2, 3. So likewise, 10,000 year 1 net cash inflow. Year 2, 60,000. Year 3, 80,000. Cost of capital is given. Required rate of return for the project is 10%. So first you have to calculate terminal year value. So to calculate the terminal year value, all these cash flows of the project, you have to compound to the terminal year. So this is the terminal year. Antima avurudha project ke terminal year is the year 3. So this 80,000 no need to compound. This is end of year 3 cash flow. So therefore 80,000 you can take as it is. 80,000 you can take as it is. But this 60,000 you have to compound for 1 year. Compounding, right? Not the discounting. So we are going forward in the timeline. So 60,000 into 1.1. So this is 10,000 end of year 1. So this is you have to compound for 2 years. 10,000, 1.1 into the power 2. So what are the terminal year values? 60,000 into 1.1. So that is 66,000. 10,000 into 1.1 into the power 2. 12,100. 12,100. So the terminal value is 12,100 plus 66,000 plus 80,000. 158,100. So what is the modified internal rate of return? It is the discount rate where this terminal year cash flow is equivalent to the cost. So then modified internal rate of return or MIRR is equal discount rate where the cost of the project. So the cost of the project is 10,000 is equal to these two values discount rate where these two values are made equal. So this is end of year 3. So you have to discount it 1 plus R. Here actually this is MIRR. Rather than saying here, this is the modified internal rate of return. So 1 plus, this is MIRR, time is 3 years. So now you can solve this for MIRR or the modified internal rate of return. So it will give you the answer. So let's calculate it. So you can rewrite this by cross multiplication 100,000 into 1 plus MIRR into the power 2 is equal to 158,100. So then you can divide 158,100 by 100,000. So then it will make 1 plus MIRR into the power, not 2, this is 3. Here, 3 is equal 1.581. So then to remove this 3, you have to take the square root of this 1.581, square root of 3 of it, 1.581. So then you can take that also 3 shift square root 1.581. So it will be 1.16, 1.164. So then this one you can get to this side. So then you will get finally you can calculate, right? MIRR is equal 16.4. Did you get it? 16.2. Yes, it is 16.405. You can solve this, right? So this is the modified internal rate of return. So this is the modified internal rate of return. So now you can compare this MIRR with the cost of capital and NPV to take the decision. Did you get this 16.4? Student, do you have any question on the MIRR calculation? Am I went past? So first you have to get the terminal year value of the project, 158,100. So then you have to solve this. MIRR mean it is the discount rate where the terminal year value is equal to the cost of the project. Here 3 years project. So therefore you have to discount it back for 3 years. So then you will get MIRR for the project L 16.5. Did you get it?
Yes, ma'am.
Right, now calculate the MIRR for the project S quickly. For the MIRR for the project S, for practicing it. So MIRR for the project S is equal. So you have to calculate terminal year cash flow. So 17,000 you have to get the terminal year. You have to compound for 2 years. This is for 1 year. So then you can get the terminal year cash flow. 70,000 into 1.1 into the power 2. This is 84,700. 55,000. 20,000 you can take as it is. Plus 84,700. So it's terminal year value is 159,000. 159,700. Right. So then MIRR you can calculate. MIRR is equal, cost of the project is 100,000 equal 159 is the terminal year value. 1 plus MIRR into the power 3. So you have to solve this. 159,700 divided by 100,000. 1.597 square root of 3 minus 1 is equal to the MIRR. It's also around 16.8, no? You can check it, right? 16.89 approximately. Is it 16.9 approximately?
Yes, madam.
Right. So this is the MIRR. So when you calculate in the MIRR, now your reinvestment assumption here, it is changing. So now reinvestment assumption is the cost of capital. So we assume cash flows are reinvesting at the cost of capital because you can see the compounding value we calculate in that cost of capital. Right. So now to realize further, I am going to this point. Now here, in this case, to solve this issue, I told you that you can apply the MIRR. Now in this case, when the cost of capital is say around 5%, if it is there is a conflict between NPV and the IRR. Now to resolve this issue, I told you that you can calculate MIRR. So now let's to realize further this point. So if I ask you to calculate MIRR of this project at 5% level, you have to do it quickly without taking much time, right? So now there is a conflict here. If our cost of capital is 5%, if it is there is a conflict between IRR and NPV. So then what we do? So now you can't say whether you are accepting project L or S because NPV say, yes, L is the one. But IRR say project S is the good one. So there is a conflict at when the cost of capital is less than this crossover rate. ඒ කියන්නේ cost of capital එක 105ක් වාගේ වුණොත් අපිට ප්‍රශ්නයක් තියෙනවා. මොකද්ද ප්‍රශ්නේ? There is a disagreement between the NPV and IRR. Now to resolve that, I told you calculate the MIRR. So let's calculate MIRR for this project at 5% cost of capital level and see whether what is happening quickly. So what you have to do, you may calculate modified internal rate of return for these two projects at 5% cost of capital level, right? Calculate the MIRR at 5%. I am 5% gatte. So at 5% there is a problem. If the cost of capital is say 5%, there is a disagreement between this IRR and NPV. So let's calculate MIRR for these two projects at 5% cost of capital level. So take at 5%. So calculate the MIRR at 5%. MIRR project L at 5%. So now you have to compound the cash flows at 5%. So you'll get 10,000. You are discounting for 2 years. So 10,000 into 1.05 into the power 2 plus 60,000 you have to compound for 1 year, 1.05. Rate is 5%, right? Plus 80,000. So you are getting compounding value for the project L here, 154,025. So now your formula is 100,000 is equal. Terminal value of the project is 154,025 discounted by 1 plus MIRR, modified internal rate of return. Time is 3 years. Now solve this. So here, once you divide 152,000 by this one, so your MIRR will be 1.540 square root of 3 minus 1. Is it 15.48? MIRR is 15.48. So MIRR for the project, is it correct? 15.48? Yes.
It is correct.
Correct. So calculate for the project S also. So 70,000 you have to compound for 2 years, 1.05 into the power 2 plus 50,000 for 1 year plus 20,000. Terminal year cash flow is 149,000. So your it is 1.496. So your MIRR will be 1.4967 square root of 3 minus 1. Is it 14.36? 36 or 37? MIRR for the project is at 5%. Cost of capital level. Is it 14.37%? Did you get this? 14.37?
Yes.
Huh?
Yes, ma'am.
Right. So now at 5% level, right? At 5% level, at 5% cost of capital level, you did the calculation MIRR for the project L and project S. Now, according to this MIRR, what is the recommending project? LOS. So this is 15.48. This is 14.37. Both projects MIRR greater than the cost of capital. Both are okay. Because cost of capital is 5%, no? So both projects are having higher MIRRs than the cost of capital. So both can accept, but these are mutual exclusive. You have to accept only one. Then you have to take the one with the highest MIRR. So you may recommend in then what? Which one?
L.
L. So then you can go with the project L because MIRR is 15.48. This is 14.37. So therefore MIR project L is the recommending one at 5% level. Now go to the diagram. So at 5% level, there is a conflict with the IRR and IRR and NPV. So according to the NPV, it say project L should accept L because NPV L is greater than this. Now MIRR, what it say? Now you have already calculated MIRR. So now MIRR say by which project? Project MIRR project L is greater than the MIRR project S. So now there is no conflict. Both NPV and the MIRR suppose recommending same project. So because of what? Now changing the reinvestment assumption, you have calculated modified internal rate of return at 5% level. So when you look at the modified internal rate of return, there is no conflict between MIRR and NPV. So that is what the point I am trying to highlight. When the cost of capital levels is less than the crossover rate, conflict is there. This is happening. This is affecting to the mutual exclusive project. So because for the mutual exclusive project, you have to select only the one. So when to kind of a problem is there, you have to work out MIRR. So then you can see with the MIRR, both are mostly agree for the this kind of project. Now look at further this example. All right. Just read this one. MIRR correctly assume reinvestment at the cost of capital. IRR reinvestment is not realistic. It's not the real world. IRR එක කියන්නේ project එකේ IRR එකට reinvest කරනවා කියලා. So that is not realistic. But here MIRR is the realistic reinvestment assumption because we assume cost of capital. We are investing at cost of capital. So MIRR avoids the problem of multiple IRR. Now there is no multiple IRR issue. MIRR දෙකක් එන්න බෑනේ. So modified internal rate of return is only one terminal year cost. You are connecting with the terminal year value of the project and the cost of the project. So you are getting only one MIRR. If management wants to know the rate of return on projects, the MIRR is the better estimate than regular IRR. Managers like rate of return comparison, MIRR better for this than the IRR. So then that is the conclusion. So MIRR is better than the IRR. Now, if you look at this example, this is another example, not connecting to the previous one. Two projects, A and B. It's very simple one. You can see initially 1,000 you are investing, 1,150 year one for project A. So 100, 100, 1,300. Which provides better estimate of projects true rate of return, MIRR or regular IRR? Explain your answer. So I'm not taking time to do this one. So what you have to do, you should calculate NPV for these projects at home. You can calculate NPV and also you can calculate IRR also. You know how to calculate IRR. So do the IRR also for project A and B. Then you can calculate MIRR also. So this MIRR calculation, you can, I think this is recording, so you can take it later even. So this is the MIRR for project A, 16.8. So these are the numbers. Look at this. Cost of capital is 10%, right? So NPV project A, 168. NPV project B, 165. Traditional IRR, 23.2, 19.1. So both IRRs greater than the cost of capital. So both projects you can accept. But anyway, when there is a mutual exclusive project, you have to go with the largest or the highest IRR. So according to the IRR, the largest value is project A, 23.2. According to NPV, both NPVs are positive. Both you can accept, but the appropriate one with the highest NPV 165. So the project B. Now you can see there is a disagreement. No, there is a disagreement because NPV say project B, IRR say project A. So conflict. So conflict. So what you have to do, you calculate MIRR. So once you calculate modified internal rate of return or the MIRR, you can see the numbers A 16.8, B 18.7. So according to MIRR, it says that project B is good. So now no conflict between NPV and IRR, MIRR. So both are suggesting take the B. Right. So with that examples also, you can further identify the requirement of the MIRR than the traditional IRR calculation. So later at home, you may calculate and check these answers and try to realize further. Right. So now we are going to the next techniques, that is profitability index. So this is also your question from your tutorial. I believe you can manage yourself because now you have learned a lot about the MIRR calculation. This is project are equal risky. Their cost of capital is 14%. Recommend the suitable project based on the MIRR. So you have to calculate MIRR based on this cost of capital level. So you have to recommend the appropriate one. So let's go to the profitability index. Before going to that, shall we have a 15 minutes break? Not max, 15 minutes. Are you okay?
What about 30 minutes?
30 minutes for what? It's around 20 minutes, right? So we are compromising. So we'll come back within 20 minutes.
Okay. Because I had to cook noodles, miss.
Sorry, my friend, are you there? No, no, 20 minutes. Come back in 20 minutes.
Okay, miss, thank you.
Right, shall we start? Are you there? Shall we start?
Yes, ma'am.
Right, okay. Can start, right? Okay, so we can discuss this one also now, profitability index. I hope you can see the screen. When it's come to the profitability index, again, this is also a very important index tool to evaluate the projects. This is a ratio. So that you can calculate this one using present value of the cash inflows divided by initial cost of the project. You can see the formula, present value of the cash inflows, project cash inflows, present value divided by the cost of the project. So sometimes some textbooks refer this as a benefit cost ratio even. So normally this is a ratio. This can be greater than 1, less than 1, or equal to 1. So likewise. So normally if profitability index is greater than 1, we can accept the project. If it is less than 1, you can reject. If it is equal, either you can accept or reject. If you look at these characteristics of the profitability index before going further, this is time adjusted cash flow based techniques because you calculate profitability index based on the present value of the cash inflow divided by the initial cost. So initial cost mean again at the cost at 0. Then when you calculate in this PI index, reinvestment assumption again is cost of capital. So that is very fair, realistic one. So we assume the cash flows are reinvesting at the cost of capital. Third bullet, if NPV PI criteria disagree in a particular point, if there is a disagreement between the NPV and the profitability index, you can go with the NPV. It is conceptually fundamentally very strong criteria, but if no capital rationing. What is this capital rationing? Fund constraint. Suppose you have 5 projects, all are with positive NPVs, but your budget or the funds are limited. You cannot accept all because your investment budget is limited. If in such a situation, to rank the project, to decide which come first, what next. So likewise, to rank the project, this profitability index is the most appropriate one. So therefore, you may underline this. PI index is a very relevant measure tool when there is a capital rationing. When there is a fund constraint to rank in the project, PI index is very relevant and appropriate one. Because this PI index shows us relative measure showing wealth increase per rupee of investment. So this is again line with the objective of our financial management. So this is a relative measure of the wealth. It shows wealth, how much the wealth will increase if you invested this particular project. For rupee of investment, wealth increasements, it by looking at the profitability index, you can understand. It's a relative measure of the wealth. So therefore, this is preferred under the capital rationing situation, fund constraining situation. So PI index you can calculate using this formula. Present value of the cash inflows divided by cost. So it can be, say, 1.2. So this profitability index is 1.2. This is a ratio. So 1.2 mean you can accept because it is greater than 1. So how to interpret this? If you invest 1 rupee of this project, your wealth is increasing by How much? If you invest 1 rupee of this project, your wealth is increasing by
0.2.
0.2 by 0.2. So that's why we say that this is a relative measure of the wealth. When you have a fund constraint, if the money is limited, if funds is limited, so this is the most appropriate measure to rank in the project. So therefore, you have to remember that. Otherwise, if there is no capital rationing, if there is a disagreement between the PI and the NPV, you may go with the net present value recommendation. Right? So like this, say net probability index can be say 0.5, less than 1. So it means that if you accept this project, your wealth is decreasing. If you invest 1 rupee, your decrease of the wealth is 0.5. There is no wealth increasement because the PI index is 0.5. If you invest 1 rupee, that 1 rupee is decreasing to 0.5. So your wealth is destroying if you invest this project. If it is 1, it means that no increase in, no decrease in of the value or the wealth. Remember, in conventional type project, when PI index is greater than 1, always NPV is positive. When profitability index is less than 1, NPV always negative. When the profitability index is equal to 1, NPV is 0. So that relationship you can identify in conventional type project in between NPV and the profitability index. So now if you look at this example, this is just calculation. So cost of the project is initially 60,000 and it is expected to generate cash inflows like this 24, 32, 28, 8,000. Assuming 10% rate of discount, just calculate NPV and PI index. So you know how to calculate NPV and PI index. Just to practice, you can do this quickly even. So you can calculate NPV is equal present value of the cash inflow. So that is 24,000. Cost of capital is 1.1. Life of the project is 4 years. Discounted for 1 year. 32 year 2 cash flow. 1.1. Discounted back 2 years. 28,000. Discounted for 3 years plus 8,000 discounted for 4 years. So this total is the present value of the cash inflow minus cost, or the present value of the cash outflow is 60,000. So that difference will give you the NPV. So then once you calculate this present value of the cash inflow, profitability index you can calculate. Present value of the cash inflow, how much? Is it 74,765? So you will get 74,765 as the present value of the cash inflow. So then PI index is equal 74,765 divided by 60,000 cost of the project. So you will get the profitability index also greater than 1.25. Net present value is positive. Did you get these answers? I hope you get in, no? Any clarification on the calculation? Right, I think you have done it. So let's look at this example. Two projects are there, A and B. Cost, initial cost 200,000 and 400,000. NPV is given 40/70. So evaluate these two projects using NPV and PI index. So according to the NPV, which project you may recommend? According to NPV, you may say which project. You may accept
B.
which. You may accept project B because of this higher NPV. So now calculate the PI index for these two projects. Profitability index is present value of the cash inflow divided by cost of the project. For the project A, what is how much the present value of the cash inflow? How much the present value of the cash inflow? Project A. For the project A, there is a positive NPV, 40,000. So then can't you trace the present value of the cash inflow if the NPV positive 40,000 is there? So then how much the present value of the cash inflow?
240,000.
240,000. So exceed the cost, there is a inflow of 40,000. So therefore present value of the cash inflow in the project A is 240,000. So divide by cost 200,000. So this is the NPV. Then for the project B also the positive NPV 70,000. So then 470,000 is the present value of the cash inflow divided by cost of the project. So profitability index, what are the numbers? 1.2, 1.17. Now you can see problem. According to the NPV, so the project B is recommending because of that it's a high NPV value. But according to the PI index, which you should select? According to the profitability index, which project should accept?
A project.
Project A, because the relative increase of the wealth for this project is high. If you invest 1, the wealth is increasing by 0.2. But for the project B, if you increase 1 rupee, but the wealth is increasing by 0.70. So therefore now there is a disagreement. So in such a condition, such a situation, so now there is a problem. According to NPV, it says that project B is the one. According to the PI index, it says project A is the one. So there is a disagreement between NPV and profitability index. So now you should have a problem. So then what you have to do, if there is no any capital rationing, any fund constraint, you may go with your decision with the NPV. But if capital rationing is there, if fund constraint is there, you have to select the project according to the profitability index. Right? So that is the conclusion. If you are facing with the fund constraint, so then someone has unmuted my microphone. Can you mute it? Someone's microphone is disturbing. Please mute it. Right. So then if there is a fund constraint, so then you have to go with the PI index. I think point is clear now. So then the importance of the profitability index is when a fund constraint is there. So your decisions you have to take based on the PI index. So in conclusion, so what is that conclusion? This is end of this budgeting, I think. So the conclusion is net present value method is the most superior investment criterion as it represents the net increase in the firm's wealth. So conceptually, theoretically, net present value is the most appropriate one. So therefore, mostly you can take the decision based on the NPV. But in a situation like fund constraint is there, you can go to with the decision based on the profitability index. So this is end of the capital budgeting. So we can spend few minutes to discuss these quick examples. Then we can start the capital structure. Few things I'm going to explain under the capital structure on the concepts related to this leverage. Not much thing because of the time limit and the things. So let's look at this example. This is actually the practicing example. So you can see here for investment project. This is from your recommended textbooks. Actually, this example is included in this Pandey's textbooks also. 4 projects are there, A, B, C, D. So you can see the cash inflows, net cash inflows. Project 1, life is 1 year project. So B, C, so likewise you are given 4 projects. So you are asking, rank the projects according to each of the following methods. Discount rate of 10% and 30%. So 2 discount rates are given. So you are asking to calculate payback period. So now you have confidence, should have a confidence to calculate the payback period because we discussed it, you learn it. So therefore now you should be able to calculate payback period and also calculate the IRR for this project. That is also we did. So you have a capability to do that also. Then NPV. So NPV you have to calculate using these 2 discount rates. So calculate the NPV for each of this project at 10% cost of capital as well as at 30%. So this is for the practice, right? So you have to practice this question rather than waiting, do the question in the final question paper. So you have to practice this question. So calculate the NPV taking a 10% discount rate and taking the 30% discount rate. Then if projects are independent, which project should be selected? If projects are mutually exclusive, which one is the best? So based on these calculations, you have to answer these questions. So I'm not going to consume the time to calculations. So I will give the answers. So you can do this thing later. So these are the answers for these calculations. Payback period for ABCD project like this. IRR for these 4 projects is like this. So NPV at 10%, A, B, C, D, these are the answers. At 30% cost of capital level, these are the answers. So now by looking at this, you have to answer these 2 questions. If projects are independent, right? If projects are independent, which project should be selected? So give me the answer. If projects are independent, What are the projects? If projects are independent. So you know what is independent projects? Projects with a different purpose. They are not mutually exclusive. So if projects are independent, A, B, C, D are independent projects. So then which projects should be selected? Tell me the answer. You are given payback period, IRR at 10% level NPV, at 30% level NPV.
Project C.
Project B.
C.
In B. Oh.
C.
So if independent, so you can see here IRR. If you look at the 10% cost of capital level, IRR for the project A is 0. No? So that is a exceptional one. So you can see its NPV also negative. So at 10% cost of capital level, you can see IRR for all projects are greater than 10%. So all are okay at the IRR. And also at 10% cost of capital level, A project A negative NPV, all others are positive. NPVs are positive. So therefore at 10% cost of capital level, you can accept project B, C, D. At 30% cost of capital level, if you take the 30% as the cost of capital level, so this project you cannot accept because IRR is 26.5. So for the project C, no problem. Again, NPV is at 30%, it is negative. So you can see there is a consistency between the IRR and the NPV. So at 30% discount rate, cost of capital level, you may accept project B and D. Right? Then part 2, if projects are mutually exclusive, which one is the best? If projects are mutually exclusive, which one is the best? At 10% cost of capital level? At 10% cost of capital level, which is the best? If projects are mutually exclusive, you can't project
D.
D. D is 3,824 NPV. At 10%, you can see this is the one with the highest NPV. So you have to take decision here based on the NPV because there is no any capital ratios and the things are not there. So therefore, if projects are mutually exclusive, your answer should be based on the net present value. So at 10% net present value level, which the project C is the one generating highest NPV. At 30% discount level, cost of capital level, so you have to go with the project D. So likewise, you have to answer. So yeah, likewise, you should have a capacity to compare projects and select, recommend. So you should able to do this thing. Just calculation is not sufficient. Should able to recommend which one like this. Right. So there are some questions I have put here. From your tutorial. So this one is not difficult. You have to calculate payback NPV, IRR. If projects are independent, which you are accepted. If mutually exclusive, which is the accepted one. So likewise, you have to explain. So this this question, this is okay. This one also you can do. You are given present value of the future cash flow, initial investment. So you are asked to calculate profitability index and the rank the project. So based on your ranking, select the most appropriate investment mix. So there is a fund constraint, right? So there is a fund constraint of 5 million. So you can accept project up to this level. මේ තමයි වාට වියදම් කරන්න පුළුවන් ප්‍රමාණය investment වලට. So what you have to do, you have to calculate NPV and the profitability index. So based on that, since there is a capital rationing, you have to rank the project based on the profitability index. Based on your ranking, select the most appropriate investment mix. So then you can identify, you can take 1, 2, 3, 4 like, but remember, limit is 5 million. You cannot exceed that. So you can invest up to 5 million. So you have to do. So let's do this one quickly. I think I can manage cost of capital within next, yeah. So if you, so this one also same thing, right? Same like budget limit is there, 1.5 million. Same question, same like. So you have to calculate the NPV and PI index. So then you are asking which criterion provide best combination of projects should make the shareholder well. So if the project are not indivisible. So that means partial of project is not acceptable. ඒ කියන්නේ ගන්නවා නම් project එක සම්පූර්ණයෙන් කැලලක් නැහැ. ඒ කියන්නේ සම්පූර්ණ cost එක සලකන්න කියන එක. Assume that projects are indivisible and the company has capacity to generate return 15% per annum. It's idle unutilized funds over the next 3 years. So how would you answer for this one? So again, profitability index based ranking, and then you have to identify which project is, which are the acceptable one. If there is unutilized funds, you can calculate for that at 15% rate. There is some return also for the unutilized funds. This is also same type question. So therefore, from these 3, I am going to do 1 with you. So all other questions you have to do yourself. Right, so let's take this one. Last question. Following investments, it's not same. So you are given this investment projects for WXYZ. Initial investment is given. NPV also given. Here NPV is given actually. Previous ones NPV is not there. Present value of the net cash flows is given. So if you know the present value of the cash inflows and the cost, you can calculate the NPV. Here also present value of the cash flow is given. So you can calculate NPV. That is the difference between these two. Same. So now here NPV is given. Each projects above comprise time span of 6 years. All these projects time is 6 years. Identical risk classes. Relevant cost of capital is 14%. So rank the project according to the NPV criterion. So you can rank first project based on the NPV. So according to the NPV, so you can rank them according to NPV. So let's do that quickly. So based on the NPV, you can rank the project W, X, Y, Z. So NPV 25 million, 18 million, 12 million, and 7 million. So therefore, first one is W. Same order, 1, 2, second one 18 million. So this is 3, this is 4. So compute the PI index for each of them and rank according to it. So calculate the profitability index here. Profitability index for this project. What is the profitability index for the project W? It is 1.125. For the project X. Here,
Yes, ma'am.
150. So that is 1.12. For the project Y. 1.12 again. Project Z. 1.14. So according to the PI index, what is the rank? So Z is the one, eh? 1, 2, 3. X and project X and Y both are with the same ranking because same profitability index, no? So this is the one with the highest PI, project Z, 1.14. So that is 1. 1.125 is the 2. So this is both you can put as a 3. Estimate the increase in the wealth considering that company is capable funding all financial feasible project. Without fund constraint, so you assume that the company can finance all projects. Company can finance all projects. So then what is the increase of the wealth? Question number 3. If all projects it can finance, now here all the projects are having positive NPVs. So increase of the wealth is equal to what? 25 plus 18 plus 12 plus 7. 25 plus 18 plus 12 plus 7. If all projects are feasible and can finance, so increase of the wealth is 62 million. So that is the total of these NPVs. So then determine the combination of the projects that the company should select, assuming that funds allocated for the long term is limited to 400 million. So now their limitation is there, fund constraint is there, 400 million maximum they can invest. So then what is the feasible project? So then you can rank the project, look at the, because now fund constraint is there. So therefore you can rank the project according to the profitability index. So if you go to the project PI index, this project Z is generating relatively high wealth because its PI index is 1.14. So then let's see for the answer for the part according to the PI index. If you go to the PI index, according to it, project Z is the first. Then we can go to the project W. For the project Z, initial investment is 50. For the project W, cost is 200. So 250. So if you take then third, both X and Y with the same profitability index. So therefore you can go to the, with the budget limit 250, 400 billion is there. So 250. So exactly it's if you take the project X from this 3 rankings, if you go to the project X, so then cost is 150. So your 400 million will utilize. There is no unused funds. Total 400 million will utilize, no, 250 plus 30, 40. So your 400 million is invested. So then if there is a fund constraint, so this is the mix. W, Z and X are the project appropriate for the investment. So determine the increase in the company's wealth in part 4. So now if you calculate the increase in the wealth, value increase or the wealth increasement, for the Z, the wealth is increasing by 7. For the W, wealth is increasing by 25 million. For the X, wealth is increasing by 18 million. So total increase of the wealth is plus 18, 50 million. So likewise, you should be able to do calculations when there is a fund constraint. Do you have any questions on this? ළමයි ඔයාලා හැදුවද මම විතරද හැදුවේ? Any question on this? So this is also similar type. So rank the projects according to NPV and PI index based on the ranking, select the most. So the budget limit here 5 million. So then line with this 5 million, you have to select the project and calculate the combined NPV and see what is the increase of the wealth by selecting this particular project mix. Right. If you have no questions, so I'm stopping the budgeting from here. So let's go to the capital structure. Do you have any question? Do you have any question on the capital budgeting? Are you okay with this?
Yes, ma'am.
Right, then that's good. So let's go to then capital structure. Right. So under this capital structure, actually, I'm just explaining few concepts only because now we are not going to in a deep analysis. So that is actually the last lesson. So with the time, I think we have no time for do the working capital and the other two topics. So under this, you will learn what is the leverage. So the conceptually, you will learn what is leverage. So you learn what is the concept of capital structure. So then you will identify the impact of this capital structure on the leverage on the capital structure. And finally, you will learn how to determine the optimal capital structure. So these are the things actually we are going to cover under this one, very small area. So let's start with concept leverage. Before going to this leverage, let's see what is the relationship this lesson to our objective. That is wealth maximization, value creation. So you know that our objective is wealth maximization is considered as the ultimate objective of a company. So this objective is more effectively achieved through the maximizing market value of the equity. So you remember in the first lecture, we say that wealth you can maximize by maximizing market price of the company share. right? So then market price of the company share can increase with the activities or the happenings in the company, with the investment. If the company is doing the investment in the value creating project, so then market price of the share will enhance. Investors will more attractive to the company, so they will invest in the company. So the demand for the shares will increase, so the market price will go up. So this objective more effectively achieved through maximizing market value of the equity shares. So equity, so now when you calculate in the value, right? You can remember in the security valuation, we calculate the intrinsic value. So when you calculate the value, this cost of capital, or we call our minimum required rate of return, or discount factor. I think we learn cost of capital now. It is influencing negatively to the value, because the basic simple formula for the value calculation, value is equal expected cash flow on this particular investment discounted using the cost of capital. So these are here discount factor, or our cost of capital, or investors required rate of return. So now you can see this value and this discount factor is negatively related. So there is a negative influence to the value from the cost of capital. When the risk is increasing, cost of capital is increasing. When the cost of capital is increasing, value is negatively affecting. So therefore, to maximize the value, because our objective is maximizing this value, you have to minimize this cost of capital. You have to maintain minimum level of cost of capital. So cost of capital can be minimized by using leverage and selecting appropriate capital structure. So this is the connection of this topic to our objective. So this is very simply how to connect in this one to our objective of financial management. So to maximize the value, you have to minimize the cost. So cost minimization you can achieve by using the leverage, or we call use of fixed cost. Leverage means use of fixed cost, or by using appropriate or the optimal capital structure. Capital structure means how to finance the capital. Optimal capital structure means so optimal debt to equity combination. So likewise, this is the broad picture of this lesson. We are going to identify these concepts only. You will learn what is leverage, what is optimal capital structure, what is business risk, what is financial risk. So likewise, these concepts you will learn. We are not going to do any deep sense of analysis. Right, so let's do, this is the map, broad sense, broad view of this lesson. So let's see what is leverage. What is leverage? අපි සිංහලෙන් කියන තෝලනය කියලා. So leverage, in business terms, leverage can be defined as the use of fixed expenses within the total cost structure of the company. Fixed expenses, fixed cost. So you know what is fixed cost? These are for a certain period. These are not changing, right? So there are fixed cost. Operating fixed cost is there. Financing fixed cost is there. Now, like say salaries, wages. So these are fixed cost. Even though your production or the unit of production or sales is change, these costs are not changing. They are fixed. They are not varying. And also, if you take the interest rate in the capital structure, when you are financing with the debt capital like debentures, bonds, bank loans, so that interest component or the coupon payment we are giving to the bondholders is not changing. When the profit is, even though the profit is going down, that interest component is fixed. It's not changing. So these are we identify as a fixed expenses or fixed cost in the total capital structure. So that is the leverage. So simple term, leverage is the use of fixed expenses. Leverage is the use of a fixed expenses. So this leverage you can use to intensify the return to shareholders. So this leverage or the fixed expenses, you should use in a appropriate way, in a way that intensify return to the shareholders or that maximize the value. Return maximizing shareholders mean maximizing the value of owner's wealth, maximizing owner's wealth. So then as a finance manager of the company should know how to manage this leverage in a way that intensify the return to the shareholders. Right. So then risk arising due to this leverage, you can identify into two. One is business risk, other one is the financial risk. This is conceptual discussion, right? So then leverage is the use of fixed expenses. So as a finance manager, you should be able to use these fixed expenses strategically, right? Strategically mean in the manner that intensify return to the shareholders. So risk arising because of this leverage, because of this use of fixed expenses, you can categorize into two, business risk and financial risk. What is business risk? What is business risk? Business risk is very simple, in very simple sense, volatility of the operating profit. So you can highlight this. Business risk is the volatility of future operating income, profit volatility. Risk is the volatility of a variable, no? Risk can uncertainty, volatility, variation. So what is the business risk? Business risk is the volatility of future operating income. So if I ask the question, what are the reasons for the profit volatility, change in the profit? So you can list down many reasons, many factors. Change in the demand, uncertainty about output prices, raw material prices, then different lines of business product, foreign exchange risk, government issues, policy changes, so whatever. So likewise, you can list down 50, 60 reasons that that's affect to the volatility or the change in the profit. On this list, there is a one variable that is we call operating leverage. One factor affecting to the business risk of a company is its operating leverage. Right? Business risk is the volatility of the profit, uncertainty about the future profit. So this profit volatility or the business risk can be affected by certain factors. මේවා බොහොම සරලයි. You know these things. Demand එක වෙනස් වෙනකොට, sales වෙනස් වෙනකොට, customers ලා වෙනස් වෙනකොට, raw materials වෙනස් වෙනකොට, profit එක වෙනස් වෙනවා. These are very common sense. In addition to that, one reason, one factor is there, that is we call operating leverage. So then what is operating leverage? Operating leverage, then leverage means use of fixed expenses. So operating leverage means refers to the use of fixed expenses in the operating expenses to magnify the impact of changes in sales in operating income. Leverage means use of fixed expenses. So operating leverage means use of fixed expenses in the operating expenses. That we are financing expenses, operating expenses. So operating leverage means use of fixed costs in the operating expenses in the way to magnify return or magnify return ultimately to the shareholder. So in the way to magnify the impact of changes in sales on the profit, on the operating profit. So that is we call operating leverage. So operating leverage is the use of fixed operating expenses, right? Fixed operating expenses to magnify the impact of change in the sales. Then sales වෙනස් වෙනකොට profit එක වෙනස් වෙනවනේ. ඒතර sales වෙනස් වෙනකොට profit එකට එන බලපෑම strategically manage කරන්න පුළුවන් විදිහට අපි fixed operating expenses use කරන එක තමයි operating leverage එක කියලා කියන්නේ. So this is very simple definition, right? I have put the very simple format. So what is the operating leverage? Use of the fixed expenses in the operating expenses to magnify the impact of changes in sales in the operating income. Now you know that in your operating expenses, in the income statement, if you have fixed operating expenses, so these fixed operating expenses are not changing when the sales levels are going up and down. In a favorable economic condition, having higher operating leverage would lead to higher operating income, as the cost would not increase with the increase of the sales. In a favorable economic condition, sales are increasing. Right? In a favorable economic condition, sales are increasing. In a favorable economic condition, having higher operating leverage is good. Having higher operating leverage would lead to higher operating income. Why? This fixed operating expenses are not increasing with the sales. So therefore, ultimately, the impact of the changes in the sales in the operating profit is positive. It is favorable. So that is why I mentioned at the beginning, this leverage you have to use strategically. Leverage එක අපි පාවිච්චි කරන්න ඕන අපිට benefit එකක් එන විදියට. So in a favorable economic condition, using the high operating leverage is okay, because with the favorable economic condition, when the sales are increasing, these operating expenses, fixed operating expenses are not increasing. So then your profit will increase. But if you look at the unfavorable economic condition, in unfavorable economic conditions, sales are decreasing, dropping, but these fixed operating expenses remain constant. So then your profit is affecting heavily. So that is the business risk. That is the business risk. So that is the how operating leverage impact to the business risk. Conceptually, so I explained two concepts: leverage, business risk, leverage, and operating leverage. Right? So this effect of fixed cost on the operation can be understood by calculating degree of operating leverage. So quantitatively, the impact of this fixed operating expenses on the profit, operating profit, quantitatively you can calculate by calculating degree of operating leverage. So degree of operating leverage, simply you can calculate. See here, percentage change in EBIT. EBIT mean earning before interest tax. Net profit, net operating profit. Divide by percentage change in sales. This is we call degree of operating leverage. So this degree of operating leverage measure the sensitivity of operating income to the changes in sales. Then if you look at this formula, you can see this is percentage change in EBIT divided by percentage change in sales. So this shows you sensitivity of the operating income to the change in sales. Suppose that your degree of operating leverage, say 1.2. So it means that if your sales is say increased by 1%, your EBIT is increasing by 1.2. So other way, if your sales is decreased by say 1%, your EBIT or the operating profit is decreasing by more than that 1.2, because your degree of operating leverage is 1.2. So quantitatively you can calculate. So let's look at this with the example. This is conceptually what is the operating leverage. So let's look at these two companies. You are provided the following information of company M, company N. Both produce 200 units using different technologies. So you can see sales for both 20,000, cost of sales both 8,000, gross profit both 12,000. So this is their operating expenses structure. Variable expenses company M 4,800, company N 1,600, fixed expenses company M 1,600, N 4,800. Just looking at this income statement, tell me which company has high operating leverage? This is a simple income statement. So you know what is operating leverage? Use of a fixed operating expenses in the operating expenses. So now with this M and N, which has the high operating leverage? M or N? Which company's operating leverage is high? Which company's operating leverage is high? What is the operating leverage? Use of fixed cost in the operating expenses. So now if you look at their company income statement, so this is their operating expenses. Company M, variable expenses 4,800, fixed expenses 1,600. Fixed කියලා කියන්නේ sales අඩු වැඩි වුණාට මෙයා වෙනස් වෙන්නේ නැහැ. නමුත් variable එක නම් වෙනස් වෙනවා. When the sales is increasing, it is also increasing. When the sales is decreasing, variable expenses also decreasing. Company N, variable expenses 1,600, fixed expenses 4,800. So by looking at this income statement, tell me which has the high operating leverage? M or N? Company N, this one.
Yes, ma'am.
Right. Yeah, that is the operating leverage. So company N's operating leverage is high because their fixed expenses 4,800. So they are having high operating leverage. Having high operating leverage in a favorable economic condition is okay. Right. So let's look at this further. This one, this is I have skipped, right? Don't look at this one. Break-even analysis, I just skip. I calculate only the degree of operating leverage. If cost of sales and variable operating expenses, right? Cost of sales and variable operating expenses are assumed to vary at the same pace with the revenue. So this cost of sales and the variable operating expenses are changing line with the sales. Assess the extent of business risk exposed by each company by calculating degree of operating leverage under this economic condition. So you are given, this is normal, right? Normal එකේ change වෙන්නේ නැහැ. මේ තියෙන තත්ත්වෙම තමයි තියෙන්නේ. If economic condition, if it is a boom, sales is increasing by 10%. If it is a recession, sales is decreasing by 10%. So let's calculate profit. Now you can see this is boom, this is recession. So you can calculate these numbers now with the boom. Sales is increasing by 10%. Now this 20,000, you can see it has increased by 10% here. Now it is 22,000. In line with the sales, you can see cost of sales also has increased by 10%. This variable expenses also in line with the increase of the sales has increased by 10%. එතකොට recession එකේදී sales are decreasing by 10%. So 20,000 decreased by 10%. So 18,000. Cost of sales also decreasing by 10%. Variable expenses also decreasing by 10%. The fixed amount, fixed operating expenses remain constant. This is for the company M, right? We make it company M. Right. So then company M, now you can calculate degree of operating leverage. So degree of operating leverage, you can calculate. This is the formula. Percentage change in EBIT divided by percentage change in sales. Right. So percentage change in EBIT. Here present for the boom, percentage change in sales is plus 10%. Here percentage change in sales is minus 10% for the sales. So EBIT change is how much you can calculate for this. 6,320 minus 5,600 divide by 5,600 into 100. So this is the percentage change in EBIT. Then EBIT has increased from 5,600 to 6,320. No. So how much the percentage change here? Simple calculation. Neka. So that is you can calculate 6,320 minus 5,600 change එක bedano initial 5,600 into 100. So how much the percentage change in EBIT in the boom for this side? 6,320 minus 5,600 divide by initial 5,600 profit into 100. Is it 12.8?
Yes, ma'am.
Right. So the percentage change in EBIT approximately 12.8. 12.8. So degree of operating leverage, look at formula and calculate. Degree of operating leverage is equal percentage change in EBIT 12.8 divided by percentage change in sales. So you are getting degree of operating leverage for the boom. You can see it is 1.29. For the recession also you are getting same answer because the same change එකක් එන්නේ. So it is also 1.29. So this is for the company M. Degree of operating leverage for the company M is 1.29. So what is this 1.29 interpret? How to interpret? What is meaning of that? It means that if sales change by 1%, EBIT is changing by 1.29 for the company M. If sales increase by 1%, EBIT is increasing by 1.29. If sales decrease by 1%, EBIT is decreasing by 1.29. Sales එක EBIT එක වැඩි වෙනවා අඩු වෙනවා same day. එතකොට so this is the interpretation. Degree of operating leverage for the company M is 1.29. So now same way calculate degree of operating leverage for the company N. Two companies ne api compare කරන්නේ M and N. So degree of operating leverage for company N. So you can calculate profit like this, change in cost of sales, variable expenses at 10% like this. So you will get answer 1.86 for the company M. So company N, degree of operating leverage is 1.86. Initially, by looking at this income statement, I asked you which company has high operating leverage. You told me that N is the one with high operating leverage because their fixed expenses in their operating expenses is greater than this company M. So therefore, company N operating leverage is high. Now you calculate degree of operating leverage for the company N. It is 1.86. For the company M, it is 1.29 degree. So compared to the company N, their operating leverage is low. For the company N, degree of operating leverage is 1.86. It implies that in an unfavorable situation, in an unfavorable economic situation, if sales drop by 1%, this company profit is decreasing by 1.86. But for the company M, their operating leverage is low. If sales drop by 1% in an unfavorable economic condition, their EBIT decreasing by only 1.29. Their operating leverage is low. So that is the operating leverage. So I'm going to the definition again. What is the operating leverage? Refers to the use of fixed cost in the operating expenses to magnify the impact of changes in sales on operating income. You may read it again. What is the operating leverage? Use of fixed cost in the operating expenses to magnify the impact of changes in sales in operating income. So now if you look at these numbers, in a favorable economic condition, for the company M, if sales increase by 1%, EBIT is increasing by 1.29. But for the company N, they are having high operating leverage. In a favorable situation, if sales increase by 1%, their EBIT is increasing by 1.86. ඉතින් අපි operating leverage එක පාවිච්චි කරන්න ඕන to magnify the impact of sales on the EBIT. So the company N operating leverage is high. In a favorable situation, අපි දැන් ඉස්සරහට පේනවා නම් economy එක හොඳයි, favorable situations තියෙන්නේ අපිට මෙයා. So then financial manager should decide to increase their operating leverage. So then they can get a benefit of this. Say when the sales is increasing, they are getting high impact, positive impact to the profit when they are maintaining high operating leverage in a favorable economic situation. But the unfavorable things are happen. Look at this. This is the business risk. If economic went worst, if sales decreased by 1%, profit is decreasing more than this company. මෙයාගේ 1.29 වලින් අඩු වෙනකොට for the company and it's decreasing by 1.86. So that is the business risk. That is the business risk. Right. So I explained few concepts now. Leverage, leverage, business risk, operating leverage. Now the next one is financial risk and financial leverage. So leverage means use of fixed expenses. Operating leverage was use of fixed expenses in the operating expenses. So what is then financial leverage? Financial leverage is the use of fixed expenses in the capital structure. Right? Financial leverage refers to the use of fixed cost in financing. You know that in the capital structure, you can finance using debt capital, equity capital, preference shares. So likewise, no, in your capital structure, if you are using large amount or large weight on debt and preference shares, so we are calling, you are having high financial leverage. Your financial leverage is high. Suppose now here, say two capital structure, right? So this is, I am drawing two companies. This is A, B. Say capital structure, 40% debt, 60% equity. Here, 60% debt, 40% equity. Which company's financial leverage is high, A or B? This is company A, 40% debt, 60% equity. Here, company B, 40%, 60% debt, 40% equity. So which has the high financial leverage? A or B?
B.
Company B, because their capital structure, debt capital is high. Debt capital means fixed cost capital. For the debt, you have to pay fixed interest. But for the equity, variable dividends. Dividends are variable, so there is no any fixed cost. But for the debt capital is a fixed cost capital. So what is then financial leverage? Again, use of fixed cost, fixed expenses, but where? In the capital structure. So refers to the use of fixed expenses in financing, in their capital structure, used to acquire the assets of the company. High financial leverage would result to larger fixed outflow of funds from the operating income, leading towards high financial risk. So higher the financial leverage, it means that higher the interest financing cost. So then a large amount of cash outflows from the operating profit. Right. So then financial risk is depends on nature of the securities issued in raising the capital. So then if your capital structure is highly weight on debt capital, high financial risk. Right? It can be defined as the additional risk concentrated on the residual owners of the business as higher financial leverage. 60% debt capital capital structure when you have a 60% debt capital in the capital structure, there is an additional risk to the shareholders. In unfavorable economic situation, there is a high fixed cost, expenses, financing expenses. You have to pay interest. Profit interest in the back, coupon in the back. So in an unfavorable situation, there is a high cash outflow as the fixed expenses for the debt and for the debt holders. So then in unfavorable situation, profit is going down. You have to pay large cash flow as the interest. So then you will be financially distressed. So that is the financial risk. You will be bankrupt if you cannot manage that. So you'll be bankrupt. So that is the financial risk. So then another two concepts I am explaining here, financial leverage and financial risk. Earlier we defined business risk and operating leverage. So now financial leverage and financial risk. So what is the financial leverage? Use of fixed expenses in the capital structure. Fixed expenses mean use of debt capital, preference shares. So higher the use of debt capital, higher the financial leverage, higher the financial risk. So again, the impact of this financial leverage on the shareholders or on the owners of the company, you can calculate using degree of financial leverage. You can calculate using degree of financial leverage. So degree of financial leverage, you can calculate percentage change in earning per share divided by percentage change in EBIT. So this financial leverage and the exposure of the financial risk you can identify by looking at this degree of financial leverage. So this degree of financial leverage shows us the sensitivity of per share, earning per share to the change in EBIT. When the EBIT is changing, how it impacts to the earning per share. With the high financial leverage, when the EBIT is decreasing, large amount of fixed interest, fixed debt cost we have to pay. So then earning per share of the company's shareholders earning per share decreasing. So high impact. So that is you can measure, that is you can identify by looking at the degree of financial leverage. For the exam, right? For the exam, at least you should be able to, by looking at this degree of financial leverage, degree of operating leverage, you should be able to assess the level of business risk and level of financial risk. So now we are going to again the same example. Same example, company M, company N. So you are given some additional information to the two companies. See, total asset, total capital, total asset for the two companies same, 7.5 million. See how they have financed it. Company M, total equity financing. So their financial leverage is, for the company M, its financial leverage is 0. No debt. In their capital structure, no debt capital. So total equity financing. If you look at the company N, equity financing 20%, debt financing 80%. So their financial leverage is high because fixed cost financing 80%. So their financial their capital structure, high financial cost is there. So their financial leverage is high. So this is high financial risk company. Now number of shares is given 300,000, 60,000 for these two companies. So let's look at, now this is the company with the high financial leverage because of high debt portion, 80% in their capital structure. So let's calculate. The applicable tax rate is 30%. So illustrate how financial leverage magnifies the return to the and the risk to the shareholder. So I told you at the beginning, leverage is a strategy. So you should be able to use the leverage in the way that magnify returns to the shareholders. So now you can look at in a favorable economic condition, how this high financial leverage increase the earning per share of the company. Right. So now let's calculate degree of financial leverage for these two companies. So let's start with the company M. I am in the same example, right? So this is the EBIT for the company M, 5,600 under the normal economic condition. If you go to this one for the company M, so under the boom, you have calculated profit, EBIT, 6,320. For the recession, 4,880. So same numbers now you can take to here, right? 6,320 and 4,880. So EBT, earning before tax, 6,320. Tax rate is given 30%. So you have to pay tax on 30%. Then net income 4,422. Number of shares of the company was given. So this is the earning per share. Earning per share for the company M. So now you can calculate degree of financial leverage. Degree of financial leverage you can calculate percentage change in earning per share divided by percentage change in EBIT. So percentage change in earning per share from here to here, you can calculate using this formula, 14.75 minus 13.07 divided by 13.07 into 100. So this is the percentage change in earning per share here. तर මෙතනත් ඒ විදිහටම ගත්ත හැකි 11.39 minus 13.07 divided by 13.07. Current minus previous divided by previous into 100. So then you will get this percentage change in earning per share 12.86. Here from here to here, percentage change in EBIT, earlier also we calculated was 12.86. So you can see percentage change in earning per share divided by percentage change in EBIT, degree of financial leverage is 1. Degree of financial leverage is 1. What it means? If EBIT increased by 1%, earning per share also increasing by 1%. If EBIT decreased by 1%, earning per share also decreased by 1%. Because for the company M, look at here, no debt, no leverage. Financial leverage is 0. Either profit එක වැඩි වෙන ප්‍රමාණයෙන්ම shareholders ලගේ earning per share එක වැඩි වෙනවා. So if profit increased by 1%, earning per share for the shareholders increased by same percentage. So this is the degree of financial leverage for company M. Now same way calculate for the company N. Same way, right? So this is the profit. Earlier we calculated this profit for the company N. So same way, only thing now you have to pay interest. You have to pay interest, 480. How this 480 is come? You go to the capital structure. Here, 80%. Here, 80% debt capital. Company and capital structure, 80% debt. So 7.5 million is the total asset. So from 80% mean how much? 7.5 from 7.5, 80% mean how much? 6 million, no? It is 6 million. For this 6 million, you have to pay interest. Cost is 8%. Debt at 8%. So then you have to pay 8% cost interest cost. So then that is 480,000. So that is the interest cost, 480. So then you have to consider that in your company, for the company in. So this is the interest expenses, 480. Same for recession and the boom. So then you can pay the tax. Number of shares was given in the question. So this is the earning per share. Profit divided by number of shares. Right. So now calculate degree of financial leverage. Change in earning per share you can calculate like earlier. Percentage change in EBIT earlier also we calculate 18.57. So this is the degree of financial leverage for the company in. For the company M, it was 1. Now here 1.09. In a favorable economic condition, if EBIT increased by 1%, earning per share is increasing by 1.09%. So that is the reward. That is the advantage of having this high financial leverage. But for this company, there is no any financial leverage. In a favorable situation, if EBIT increased by 1%, earning per share also increasing by 1%. No advantage because their financial leverage is 0. But here, they are maintaining some financial leverage, 80% debt capital. So in a favorable economic condition, if economy is going favorable, so then EBIT is increasing. So once the fixed financing expenses is deducted, shareholders are getting large amount. මොකද fixed cost එක වැඩි වෙන්නේ නැහැ නේ, EBIT එක වැඩි වුණා කියලා. ඒතකොට ඒ ටික ගෙවුවට පස්සේ shareholders ලට ඉතුරු වෙන ටික වැඩි වෙනවා. So therefore in a boom or in a favorable economic condition, if profit EBIT increased by 1%, earning per share is increasing by 1.09. But the problem or the risk is if EBIT decreased by 1%, if there is happening a recession, so their earning per share is decreasing by 1.09. So this is the financial risk. This is the risk. So if unfavorable situation is a rise, there is a risk. So that is the financial risk. So then I will go to the definition again. What is financial leverage? Refers to the use of fixed cost sources in financing, right? That is the financial leverage. Higher financial leverage would result in larger fixed outflow of funds from the operating income, leading towards the higher financial risk. Right? So here, financial risk depends on the nature of the securities companies issued. So higher the debt capital, higher the financial risk. So you can see financial risk is the additional risk concentrated to the owners, so the shareholders of the business as a higher financial leverage. So these concepts I have explained with this calculation also. So I think you should able to realize these things. So I explained you business risk, operating leverage, financial risk, and financial leverage. So now what is this combination impact? Leverage mean financial leverage plus operating leverage. So what is the combined leverage? Combined leverage mean if you combine these two. Now, if you look at this income statement, this is a format of the income statement. Here, sales, cost of sale, gross profit, operating expenses. This shows the operating leverage of the company. After the calculating of the net profit, interest, after this EBIT, interest expenses, tax. So net income. So this part shows the financial leverage. So company income statement shows you both operating leverage and financial leverage. So what is the combined leverage? Degree of operating leverage into degree of financial leverage. So now you can remember degree of operating leverage, you can calculate. What was the formula for the degree of operating leverage? Percentage change in EBIT divided by percentage change in sales. This is the degree of operating leverage. So what is the degree of financial leverage? Percentage change in earning per share, percentage change in EBIT. If you combine, so that is the total leverage or the combined leverage. So you can see by combination, there is a trade-off. So then degree of combined leverage is equal percentage change in, this is earning per share, divide by percentage change in sales. So it shows you when the sales is changing, how the earning per share is impacted. So that is we call combined leverage or the total. So it reflects or the sensitivity of firm's earning per share to the change in sales. So that is combined leverage. Now, if you calculate the combined leverage for this example, look at here. For the company M, this is their operating leverage. This is their financial leverage. For the company N, this is their operating leverage. This is financial leverage. So combined leverage mean 1.29 into 1, 1.86 into 1.09. So this is the combined leverage. So for the company N, you can see high operating leverage, high financial leverage, high combined impact. So if sales is increased by 1%, earning per share of the company N is increasing by 2.03. If sales is increased by 1%, earning per share only increasing by 1.29 for the company N because of their low operating leverage, low financial leverage. Opposite way, if sales drop by 1%, this company's earning per share is decreasing by 2.02. So they are having high financial risk, high business risk. But for this company, if sales decrease by 1%, earning per share of this company is decreasing only by 1.29 because of the low business risk, low financial risk. So likewise, you should be able to identify these 3-4 concepts: business risk, financial risk, operating leverage, financial leverage. So I explained 4 concepts with this calculation. Did you get it? Any question? You may read the recording. You may read the reading chapter, and also the recording. You can ask it again. So I explained only the 4 concepts, right? So not much thing with the calculation. Even I shows you, I illustrate you how this is happening. So last point is capital structure, optimal capital structure. So you should know this concept also. What is the optimal capital structure? Optimal capital structure mean, because you know that capital structure is important, it's affect to the cost of capital. So the cost of capital is affecting to the value. Cost of capital and value negatively related. I think at the beginning I showed you. So therefore having optimal capital structure, optimal level of debt capital, optimal level of equity capital is important to maximize the value. So capital structure having minimum weighted average cost of capital while maximize value of the company, we call it is as the optimal capital structure. So what is the optimal capital structure? It is the capital structure where weighted average cost of capital is minimized and value is maximized. When the WACC, weighted average cost of capital is minimized, value is maximized. So that is we call prasasta optimal capital structure. So target capital structure mean if you are not in the optimal level still, so we are planning to go to the next level or to the next capital structure. So that is we call target capital structure. So target capital structure can be the optimal one or not. That is another concept in this capital structure. Target capital structure is the capital structure that is we are planning to have in the future. Right. So now let's look at this optimal capital structure with the example. So you are for the Alpha PLC company, you can see you are given capital structures like this: debt and equity capital structure, debt, equity capital structure like this. So amount borrowed, these are 1, 2, 3, 4, 5, 6 capital structures. For the one, debt is 0. For the two, you can see amount borrowed is 1.5 million, 4.5 million, 7.5, 10.5, 15. So likewise. So this is the cost of debt. This is the cost of equity. Right? So if their total asset value is 15 million, so 15 million wali, within 1.5 is the debt. 15 million, 4.5 is the debt capital because this is amount borrowed. From the 15 million, here total from the debt capital. And the tax rate is given like this. So identify the optimal capital structure. So what you have to do, you have to calculate weighted average cost of capital for each of these capital structures. Then api WACC එක calculate කරන්න ගිය සතියේ. Cost of capital we calculated. So for each of these capital structures, you have to calculate WACC. Here tax rate also given. Tax is 30%. So after tax basis, debt capital you have to adjust it for the tax. So you have to calculate cost of capital. So I think you remember how to calculate that. So likewise, this is debt to total asset ratio, weight, cost of debt, after tax cost of debt, cost of equity. This is the WACC. So you will get the answers like this. Here, amount borrowed is 0. Debt to total asset weight is, debt weight is 0. Now you can see when the debt is 1.5 million because total asset is 15 million. There are 15 million only, 1.5. So that is divide by 15 million. So the weight, so then 10%. So likewise, this debt to total asset ratios we have calculated. 30%, this is 50%, 70 and 100. So cost of debt was given, right? For each, you can see these are given. Cost of equity also given. So then debt, this is before tax basis. So you have to adjust it for the tax. Tax rate was given as the 30%. So after tax adjusted cost of debt, you have to calculate like this cost of equity. So this is the WACC. So now you know how to calculate WACC. Weight on the debt, after tax cost of debt plus weight on the equity. So here equity weight is 100. Debt is 0. No? So this is 100 weight. So therefore you can say WACC also 8%. Now here 10% debt in a 90% equity. So this 7.62 is how 4.2 into 10% plus 8% into 90%. So likewise, we are calculating weighted average cost of capital for each of these capital structure. So what is the optimal capital structure? For the exam, by identifying weighted average cost of capital, you should be able to identify what is the optimal. So optimal capital structure is the capital structure where weighted average cost of capital is minimized, value is maximized. So accordingly, according to these six capital structures, this is the optimal capital structure. 6.C is the weighted average cost of capital. So this is the optimal. So at the optimal level, you can see 50% debt capital, 50% equity. So this is the optimal capital structure. So for the exam, you should be able to identify this optimal capital structure by calculating these numbers and like this. In the optimal capital structure, there is a relationship like this. So you can see this is debt ratio. This is weighted average cost of capital. Normally, when the debt ratios is increasing at the initial level, weighted average cost of capital is decreasing like this. Right? It is decreasing like this. This is because of the tax shield. ඔයාලට මතකයි debt capital එකේදී අපි tax benefit එකක් ගන්නවා. Tax shield එකක් තියෙනවා. So therefore at the initial level, when you are increasing the debt level, debt amount, your weighted average cost of capital is decreasing like this. But after certain minimum point, weighted average cost of capital is going to increase. So this decreasing is because of the tax shield, tax advantage. After this point, this is increasing because of what? Agency problem and financial risk. So now financial leverage is increasing, unnecessarily financial risk is increasing. So weighted average cost of capital is increasing, value is declining. So up to a certain level, there is a benefit of the tax shield, but after certain borrowing, if you are borrowed more than this, you are getting risk because financial risk, financial distress. Now, if you look at this table, even you can see here, debt is 0 here, cost is 8%. Now here debt level is 10%, cost is decreasing 7.62. Further increase, debt level 30%, cost is further decreasing because of the tax shield, tax advantage. After this minimum point, it is going other way. When the debt level is 70%, look at this, cost is increasing. When the debt is 100%, cost is further increasing. So this kind of nature you can see in the weighted average cost of capital with the borrowing. Initially, you are getting tax advantage. After certain or the optimal level, you are taking agency problem. Because high debt level, agency problem can arise between the, you can remember, debt holders and owners agency problem. That is a cost, agency cost will come. And also with the financial risk, with the high leverage, financial risk is affecting to the company. So therefore, weighted average cost of capital is increasing. So that behavior you can observe in the WACC or the weighted average cost of capital with the increase of the debt level. Right. So what are the determinants of capital structure? So these things are nicely explained in your reading material. I will explain very simply. What are the determinants of the capital structure? If the company want to retain full control of the business, better to decrease the debt capital. Importance of the precise identification of the payments. If you want to identify clearly what is the cash outflow, so then you can increase the debt, because when there is a more debt, we know that what is our financing cost. But for the equity capital, dividends is fluctuating. So identification of the cost or the dividends is typical. So if managers want to identify the payments exactly, so you can increase the leverage, debt level. Ability to the company make the fixed regular payment. If the company is in the matured company, if they have ability to pay the fixed payment regularly, so we can increase the debt level. Growth opportunities. So we can see the companies having very good growth opportunities in the near future. So increase the leverage, increase the borrowing. With the favorable situation, ultimately shareholders' wealth will maximize. So if there is a growth opportunities in the near future, you can increase the leverage, financial leverage, and as well as operating leverage. Average level of the leverage in the industry. We are working in a particular industry. So you can look at the average industry level leverage. If our company's leverage is greater than, higher than the average, you have to reduce it. Right? We have to reduce it. Otherwise, investors may not attract you to our company. So you have to analyze our company's leverage level with the industry average. Level of credit rating. If our company has high credit worthiness, if the company is not going to the crib, we are not any default history. So then you can increase the borrowing, because you can compromise with the banks, financial institution to get the lower interest rate. So you can increase the borrowing. You can increase the financial leverage if there is a good credit rating. Then amount and structure of the assets available for the company to be used as the collateral. If you have appropriate asset to use as the collateral, so then you can increase borrowing to a certain level. And also the tax rate. So you know that with the tax, capital is getting advantage, tax shield. If the company tax rate is going to increase, or the government is going to increase the tax rate, to take the advantage of this tax shield, you can increase certain borrowings. You can increase the borrowing to a certain level. Extent of the business risk. If your business risk or the operating leverage is high, you have to think about borrowing more, because with the business risk also high, So if you increase the borrowing, your financial leverage also goes up. So that is affecting to the total leverage. So therefore, you have to careful when the business risk is high, should reduce the financial leverage. So these are the determinants of the capital structure. These points elaborate in the reading material very appropriately nicely. So you should read. So this is end of the capital structure. I'm luckily I able to manage this one also by 12:30. Anyway, I know I went past.